In structural engineering, we have a principle called the factor of safety. It's the ratio of a structure's absolute strength to its intended load. If you build a bridge to hold exactly 10,000 tons and a 10,001-ton convoy drives across, that bridge fails. So we build it to hold 20,000 tons. We over-engineer it. In 1994, a financial planner named William Bengen designed the most famous bridge in retirement history, the 4% rule. It was elegant, it was simple, and for the last 30 years it has been the gold standard for how millions of people plan their financial future. But as a structural engineer who studies wealth, I'm here to tell you that the 4% rule is no longer a safety factor. It is a design flaw. This rule was built for an economic climate that no longer exists. It relies on materials, specifically bond yields and valuations, that have degraded significantly since the original blueprints were drawn. If you attempt to cross the retirement gap today using a static 4% withdrawal strategy, you are driving a heavy load over a bridge that has developed critical fractures. Today, we are going to stress test your retirement portfolio. We will look at the specific data from 1994 to 2025 that proves why this static design fails in a dynamic environment. And then I'm going to show you the retrofit, a dynamic spending strategy that reinforces your wealth against the one force the 4% rule cannot handle: volatility. I'm host name, and this is the yield architect. Let's look at the original blueprints. When William Bengen published his study in October 1994, he was looking at historical data to find a safe withdrawal rate, a percentage of your portfolio you could spend in year one, adjusted for inflation every year thereafter, without running out of money for 30 years. He determined that 4% was the floor. Even in the worst historical scenarios up to that point, 4% worked. But an engineer never looks just at the result. We look at the conditions. The economic weather in 1994 provided a massive structural cushion that you do not have today. Data point 1, the bond yield cushion. In 1994, the 10-year US Treasury yield hovered between 7% and 8%. This is critical. It meant that the safe portion of your portfolio, your bonds, was generating a massive amount of income. If stocks crashed, your bonds were paying you a nearly 8% yield to wait it out. Fast forward to the 2020s. For most of this decade, yields were compressed near zero. And even after the rate hikes of 2022 and 2023, we are nowhere near that 1994 safety net. When the load-bearing capacity of your bonds drops by half, the bridge becomes weaker. Data point 2, valuation, the CAPE ratio. We measure the stress on the stock market using the Shiller CAPE ratio, cyclically adjusted price to earnings. It tells us how expensive stocks are relative to their earnings over 10 years. In 1994, the CAPE ratio was around 21. That is reasonable. Entering 2025, we have seen CAPE ratios fluctuating near 40. What does this mean? It means you're buying the bridge's materials at double the price for lower expected future returns. High valuations historically precede low returns. Bengen's rule worked because it backtested periods where valuations started low and expanded. It was not designed to launch from a platform of extreme overvaluation. Data point 3, the correlation failure of 2022. This is the fracture point. The 4% rule assumes that stocks and bonds are uncorrelated. When one goes down, the other goes up or stays flat. This balance is the steel reinforcement in the concrete. But look at 2022. This was a 100-year storm for a 60-40 portfolio. The S&P 500 fell 19.4%. The US aggregate bond index fell 13%. Inflation peaked at 9.1% in June 2022. If you were following a static 4% rule in 2022, you were mandated to increase your withdrawal by 9.1% to match inflation, while your portfolio value collapsed by nearly 20%. You were removing more load-bearing material exactly when the structure was weakest. This is not a safety factor. This is structural suicide. In engineering, we worry about resonance, vibrations that match a bridge's natural frequency and tear it apart. In finance, this resonance is called sequence of returns risk. The 4% rule is a static calculation. It assumes you withdraw the same inflation-adjusted dollar amount regardless of what the market is doing. This creates a mathematical disaster known as reverse dollar cost averaging. When you are accumulating wealth, you buy more shares when prices are low. That is good. When you are withdrawing wealth using a static rule, you are forced to sell more shares when prices are low to generate the same paycheck. Let's look at the data for a retiree who started in the year 2000. The height of the dot-com bubble. This is the lost decade. 2000. S&P 500 down 9%. 2001 down 11%. 2002 down 23%. If you retired in 2000 with $1 million and strictly followed the 4% rule, adjusting for inflation, by 2003 your portfolio was not just down because of the market. It was hollowed out because you sold triple the number of shares to get your cash. By the time the market recovered in 2013, it didn't matter. You had already sold the engine that produces the growth. Studies show that a 2000 retiree following the rigid 4% rule would be on a trajectory to run out of money entirely, or be left with a dangerously thin capital base by 2025. The calculation error is assuming that the average return matters. It does not. The sequence matters. If the bridge collapses in the first 5 years, 2000-2005, it doesn't matter that the weather was sunny in years 6 through 30. So, if the static bridge is dangerous, how do we fix it? We don't just hope for better weather. We install active dampers. We make the bridge flexible. In wealth engineering, this is called dynamic spending. Instead of a rigid rule, I will withdraw $40,000 plus inflation no matter what, we use a variable rule. We link your spending to the structural integrity of the portfolio. There are 2 primary methods to retrofit your portfolio. Solution A, the guardrails approach, Guyton Klinger. Think of this as a suspension system. You set an initial withdrawal rate, say 4.5% or 5%. Upper rail, if your portfolio grows and your withdrawal rate drops below 4%, meaning you're rich, you give yourself a raise. Lower rail, if the market crashes, like in 2008 or 2022, and your current withdrawal rate spikes above 6%, meaning you are depleting capital too fast, you take a pay cut. Historically, this pay cut is small, usually 10%. But that small 10% reduction during a crash like 2022 stops you from selling those depressed shares. It preserves the shares so they can recover when the market bounces back. By accepting flexible income, you virtually eliminate the risk of ruin. Solution B, variable percentage withdrawal, VPW. This is the more advanced engineering solution. With VPW, you don't pick a dollar amount. You withdraw a percentage of the portfolio based on your age and current portfolio balance. If the market drops 20% in 2022, your withdrawal drops. You naturally spend less when the portfolio is weak. If the market rallies 25% in 2024, your withdrawal increases. You spend more when the structure is strong. This method guarantees you never run out of money because you are never withdrawing more than the math allows for your life expectancy. Why this works? The data. If we apply the guardrail strategy to that unlucky 2000 retiree, the outcome changes dramatically. Yes, they would have had to tighten their belt in 2001, 2002 and 2009. They would have taken less income during those stress tests. But because they reduced the load during the storm, their capital survived. By 2025, instead of being near depletion, their portfolio would have recovered along with the S&P 500, likely exceeding their initial starting balance. The 4% rule wasn't a mistake. It was a product of its time. But using it in the mid-2020s with high valuations, volatile inflation and complex bond correlations is ignoring the data. You cannot fight the market with a calculator from 1994. You need a structure that bends so it doesn't break. You need to move from static withdrawals to dynamic spending. This shift requires a change in mindset. It requires you to be an active manager of your own liquidity, to be the engineer of your own wealth. If you want to see the exact spreadsheets I use to calculate these guardrails, or if you want deeper stress tests on the 60/40 portfolio in this high-rate environment, make sure you are subscribed to the Yield Architect. We don't just build portfolios here, we engineer them to last. I'll see you in the next briefing.